Ladies and gentlemen, the real estate market is definitely being shaken up. We got commercial real estate being affected, which includes office and industrial. And not only commercial real estate is going to be affected, also as residential real estate is going to be affected. We're going to be talking about this in today's episode. Ladies and gentlemen, you reach the Financial Almanac. I'm Basil. Did you know in San Francisco, California, prices of office commercial buildings are expected to drop by 80% by June and July? That is insane. Not only that, we also see that Blackstone, right? This real estate, income trust that they have worth billions of dollars. Investors try to take out their money, and they said no to their own investors that have put their hard sweat money into this trust. They said, hey, we want our money back because of this shakeup in real estate. Blackstone said, no, this is our income trust. You agreed to the terms and conditions. You're only allowed to withdraw 2% per month and 5% per quarter. You will not be withdrawing $4.5 billion. That's what people wanted to take back. Their investors want to take back $4.5 billion. And they said, no, this is not the first time, ladies and gentlemen. This is the sixth time, which is insane. Not only that, at realtor.com, we see that residential prices are dropping. So we're going to go right ahead and cover all this and much more. Before I get into which areas that you will find very lucrative for you because of a huge drawdown in residential real estate, I want to touch on something I spoke about in my previous video, and that's commercial real estate. So if you watched my previous video or heard other people talk about this, you probably are well aware there's about to be a huge market disaster in commercial real estate. But before I get into that, what is commercial real estate? Well, commercial real estate has to do with businesses, right? Businesses include offices, right? In office buildings. It includes industrial manufacturing. It includes shopping malls, right? It includes restaurants. It includes anything that needs a business license and it's registered, right? That's commercial real estate. It has offices, industrial, manufacturing, shopping and eating, you name it, right? Everything pretty much outside of residential where you stay at a home or a house or a condo or an apartment. Now, for a lot of these commercial real estate businesses, right, whether you're a restaurant or a shopping mall or an office building, guess what? They don't actually own the property, right? They don't own the real estate. What they do is they generally rent. This is the most common practice. People out there can make a lucrative business model if they go hunting for commercial real estate because, these businesses tend to be good tenants and tend to pay on time. Now, these guys definitely do rely on their rental income to help them pay for the bills because, when investors and hedge funds and real estate income trusts, they come together, they say, hey, we're going to, support and, buy the commercial real estate. They've invested in total up to like around 21 to 23 trillion dollars in the economy. Now, what happens if this $21 trillion gets popped? That's why it's imperative and so crucial that these hedge funds, real estate income trusts, or even the investors basically make a profit because they need that income, they need that cash flow. If they put in tens of millions of dollars or in some cases hundreds of millions of dollars, right? And they have a publicly traded company, we as investors in our society, the regular person would be able to have access and invest into real estate companies without direct ownership of that property as well, right? So there's big business out there when it comes to managing and administrating the affairs of real estate companies as well. It's imperative that people make their payments on time when they're leasing and you're a tenant for, commercial, even private, residential real estate, because businesses rely on this as well. And so what we're seeing, how it all started is basically a group of investors, right? Sometimes if it's like $100 million deal or, one or two investors come along, they have $10 million, they'll invest into a commercial real estate. And if it's a publicly traded company, regular guys like you and I will be able to invest into those public companies that have exposure to commercial real estate. And they buy it for cheap. These businesses will buy it for cheap, work on it, and hopefully ideally make a profit with a good reliable tenant. And that was the plan. The plan was to find a good publicly traded company that had exposure to commercial real estate that is able to generate this cash flow from their tenancies, right? And that would give us the best opportunity to create passive flow for our income or dividends. But that doesn't last very long because as we see right now, things are shaking up quite a bit. Commercial real estate is quite a bit different than residential real estate. For example, if you own a home, you might know that you go to a bank and you want to qualify with your income. They'll say, okay, your amortization will be 20 years or 25 years or 30 years, and your mortgage will be smaller payments within that, right? Let's say 5 years or 10 years or even 20 years, right? So you can have a long mortgage for 20 years or even 30 years in some institutions. Commercial real estate, it's a little different. Commercial real estate, their amortization, yes, might be 25 years, but they don't have the option of long duration mortgages, right? On average, generally speaking, it's between 3 to 7 years, right? Yes, they might have a fixed rate, and if they're unlucky in today's time, they might have a variable rate. But generally speaking, it's a shorter term than residential, right? So that's another exposure. What makes commercial different? Another thing that makes it different is actually something called balloon payments, where, over time, if you're paying off your residential where you live, your mortgage, you're paying at a fixed rate for the next 5 years or 10 years, and you're making your payments. What happens with commercial real estate, as they're making their payments and they're paying down their loan over time, year 1, 2, 3, 4, 5, 6, guess in year 7, there's something called a balloon payment where you make a lump sum payment. And if your property devalues and your balloon payment is based on the pre-existing mortgage, guess what happens? You're actually paying more than the property is worth. And that's a huge Achilles heel for the commercial real estate market. That's why properties cannot be overvalued, or at least, you want to buy it at a discount so you avoid that balloon payment. Another Achilles heel is basically the FOMC interest rate that we have today at 5.25 that may potentially become 5.5 in the June meeting. This interest rate has put a lot of pressure on commercial real estate because we have so many properties coming up for renewal for their mortgage renegotiation. It's going to be flooding the market, and if you watch my other video, you're going to realize there's so many reasons why it won't be affordable for so many tenants, right? And so many landlords and so many businesses. It's just ridiculous. If you want to get into that detail, check out that video. But yeah, here's overall the rundown, right? We have properties in offices being very expensive. You have administrative fees, you have insurance, you have property taxes, right? And then a lot of people are working from home now, and their remote work isn't really conducive to going into the office. People are realizing the bottom line matters for the company, so they don't need the office space as much as they used to. Anyways, there's a whole structure there. And with the interest rates, at 5.25 or 5.5, that's jumped quite a bit from the last 14 months, right? And so this is putting immense pressure on renewing for a lot of business owners because they tend to be bleeding cash if they haven't adapted to this, right? It's huge amounts that is being, coming up for renewal, and commercial real estate and experts and, people are saying that up to 25% won't be able to make it. If not, that's a conservative amount. It might even be more. It might be up to 50% of office commercial real estate may not be able to renew and actually have to sell. That's why we're seeing in San Francisco, experts are saying up to 80% have to be sold at a cheaper rate, which is insane. When it comes to commercial real estate, it's basically based on three things when you're putting it together. Commercial real estate matters on developing the land. Where's the land? Where is it located? And how much does that cost? Number two is the square footage. How much does that cost, right? To put up this constructed building and to, put it all together, and what is the square footage cost of that? And the last but not least is the price, the yield on how well it will perform for you once the land is taken care of and the construction is done and you're about to run your business. How much yield can you generate? For example, if you and a group of people came together and put down $10 million on, getting a land, right? And building a business, constructing it, and now you were thinking about how much profit you will make, and after 1 year, your $10 million for the group has yielded you $1 million. That's per year, that's 10% return. Not too shabby. If you make 500,000, $500,000, that is 5% on your initial return. Not too shabby either. The thing that you can control is how much rent you'll be charging these businesses for being in your property. in your shopping mall, for example, or in your restaurants or whatever. The price that you dictate will affect how much profit, because that's what's controllable in your situation right now. Now, with the interest rate being, at 5.25 or 5.5 come June, and, contracts are renewing and you have to renegotiate, that might be tough, because guess what? That 5%, $500,000 with your $10 million investment, people are going to get treasuries and money market accounts that are a lot more safer and guaranteed and backed by the government for the same yield. And if rent is going up and you have to pay property taxes, insurance, you have to pay management fee for your agency that collects all of this, well, it's not just 10% or 5%. There's hidden expenses. And a lot of places have vacancies in their offices, right? So what that does is their bottom line gets bled. And it's not looking too good for a lot of these owners. So they might have to sell. Now, with the selling, and if everybody's going through this exact same hardship, it's going to flood the market. There's going to be so much commercial real estate flooding the market with very few buyers, with little demand, increased supply. Price drops significantly, and that's what we're worried about, especially if we're entering a recession, right? And if the recession is around the corner and the stock market is only being held up by, say, like the FANG companies, the big five, but everything else is, in the red, and those companies now are just like, okay, we're gonna take our profits. Big sellers come and they sell that. Well, the whole thing, that's gonna initiate the crisis in the stock market. People are gonna take that fear and translocate that even more into the real estate market, and then the mild recession might generate into something a little bit more severe, and that's the worst case scenario. So that's why you want to make sure that you take some profits right now. If you're in the green, make sure to take a haircut. I'm not saying sell all of it. That's fine if you want to hold on to it because you have a long-term plan. Maybe it's in your retirement and you bought something at a really good price, but at least have some dry powder. Sell a little bit of what you're in the green with, right? That way you have some cheddar, you have some cash on hand for when the market corrects, let's say by December and January. Right? When companies are doing tax loss harvest. But going back to real estate, if mortgages are around 7% and you can have a savings account or a treasury bill giving you 4.5% to 5%, and you're not guaranteed that these guys will be able to make their bill payments for, the business that you're leasing because nobody's spending, consumer demand, data is showing that people are spending less and are on that survival mode, why would you take that risk? So a lot of people are saying, hey, you know what? I might not renew. I might just take what the treasury bills are giving me, right? The money market accounts as well. I might not have to renew. And, if I don't sell it, whatever, I'll sit on the land. But if you sit on the land, you still got to pay all these prices and taxes and insurance. Oh my God, let's just get rid of it, right? And take that money and put it into a treasury bill or a savings account, or at least find a way where we can have it when the market peaks out of recession and things are really bloody, and repurchase what we need to. But in the meantime, we're not going to hold that bag going down because of property taxes, insurance, administrative fees. You know what I mean? It's a lot of bills. So with all this in mind, essentially, if you were to stay in the real estate business, you would basically have to increase rent. But not a lot of people are doing that. In fact, the opposite is what we're seeing. We're seeing rent prices go down because valuations are weakening with these businesses, even in residential units as well. So in order to have rent go up, meaning your yield has to go up, and it's very tough to have this, profit, because not only are treasuries and savings account, you're competing against, but there's the possibility that the FOMC meeting in June might increase, the interest rate that, your property might come and renew on. So you're thinking, man, oh man, how am I going to increase rents when people are being laid off left, right, and center? We see businesses close down, and Disney and all these major corporations close down. There's going to be a huge unemployment flood into the market, and who's coming up with this money to pay for these leases, right? So it's very tough for the businesses and the commercial real estate. In fact, that brings me back to what I was alluding to before regarding Blackstone. So Blackstone is a great example because we see this consensus generally shared across Wall Street. Now, Blackstone is a company where it's a real estate investment trust where the public can invest money into what they have exposure to. Now, Blackstone has exposure to data centers, hospitality, rental housing, industrial, commercial, real estate. So there's quite a bit of exposure that they have. Now, Blackstone has a segment that isn't publicly traded and it only deals with accredited investors, high net worth investors, right? And so when they have their money in there and they say, hey, we want to withdraw some of our money, guess what? The real estate market isn't very liquid. It's not like you can click a button and sell it right away. It's a slow process to sell a property. And so we see Blackstone having this issue where a large amount, over a quarter of their investors want to withdraw $4.5 billion as of just last month of April. That is huge. And guess what? This is the 6th time they said no. And because of this illiquidity in real estate in general, right? They have conditions in their terms and agreements saying you can only withdraw 2% of your investment because of this illiquid supply and how long it takes to sell a property. And you can only withdraw 5% max per quarter. I understand that real estate is a very illiquid market where it takes a little bit of time, a few months to make a sale. Now, let's say, for example, you and your friends got together and you purchased a property, right? Let's say there's 100 of you guys, right? And 5% of you guys, 5 people out of the 100 wanted to sell. It won't be that hard to, get the money together just to buy them out. But if 40 of the 100 wanted to sell and 60 did not want to sell, well, then what do you do, right? It's a little bit more complicated. So that's why these conditions are in place, because of the illiquid nature of the real estate sector. Not only do we see Blackstone Real Estate essentially say, guys, we cannot give you $4.5 billion that you requested in April. We can give you some. We can give you 29% of what you requested, which just amounts to what is that, $1.3 billion out of $4.5 billion that investors wanted to withdraw. We don't only just see this problem in commercial real estate, actually. We also see this in the largest U.S. single home owners, Invitation Homes, where since December of last year, the mortgage rates have increased, and that's when the FOMC increased their interest rates. We're seeing that the amount of single home families that Invitation Homes are purchasing go down over time as well. So this is definitely affecting residential also. If we're seeing Blackstone, investors trying to withdraw their money, and Invitation Homes trying to scale back and the amount of properties that they're buying because it does no longer make sense for the bottom line, what makes people believe that the real estate market isn't falling? To support this idea as well, Realtor.com has just released that year over year, from April 2022 to April 2023, the amount of sellers that are trying to list their residential real estate property grew by 48%, which sounds good initially. Yay, 48% year over year, good job. But guess what? That was still below pre-pandemic levels. Not only that, they're actually seeing the amount of buyers, right, for that same month of April not really increase for any region in the US. There's not one region in the US where there's more buyers buying this abundance of properties coming out. So what does that do? If there's no demand and supply is okay, it's gonna go down. If the number of people that are listing don't match the pre-pandemic levels, right, and there's no demand at all, why would people, break their current mortgage rate if they're locked into a lower rate and renew at a higher rate? It doesn't make sense. So I'm sure even demand is gonna be held back because the interest rates to renew your mortgage is gonna be pricey, assuming you have a really good rate. So people are not really selling, even though they can see that no one's really buying either, right? Who wants to pay these high mortgage rates? In addition to all of this, compared to last year of April 2022, April 2023, Realtor.com is also sharing that the prices that people are listing for are in the market for 49 days year over year, right? That's a 17-day increase compared to the year before that. So it's taking longer to sell and there's fewer buyers, meaning, hey, if you want to sell something, you're spending 49 days on the market on average, which is a longer time than it used to be the same time last year. And that was during times when the interest rate was lower and the mortgages were a lot more reasonable and there was a little bit more demand back then. Today, the interest rates are not reasonable for the mortgage, sector, and you're going to be on the market for a little bit longer because the demand ain't really there for you. The good news is it's not as bad as it was during COVID because we are 12 fewer days than the April of COVID. So Yeah. So what does this mean for you, and how can you, navigate this sort of situation that we're seeing in real estate, right? And so whether you're investing in Blackstone, you have to know that this is something that will happen in real estate. Generally, it's a little illiquid compared to indexes and ETFs, for example, right? So when generally you invest in real estate, I want you to understand that you should be in there for 5 to 10 years, right? And because it's an illiquid market, you don't want to overvalue a property and overpay because you need access to that property, right? You still want to have good valuations at a cheaper price, and you can get a good return on it in the 5 to 10 year horizon. So with real estate in mind like this, right, for 5 to 10 years, you still have to, if you sell a property, you're going to have to do closing costs. It's going to take a few weeks to up to a few months as well. So having said that, if we see how Blackstone is basically having their investors withdraw their money, they're expecting a few things: that either the real estate market's going to go down and they can have some cash to re-enter the market, or they might just receive subpar returns as well. But it's not all real estate, again, that's in commercial. It's specifically office real estate. Sometimes we're seeing lower vacancies and, things like warehouses, and, it's not too bad when it comes to hotels as well. They're doing quite well compared to their sector in commercial real estate. As we covered in the previous video, JP Morgan does expect around 21% of office commercial real estates to be delinquent. And this will affect about 41% of regional banks that are carrying these loans as lenders. That also means that, 79 or 3/4 of, commercial real estate is going to be okay and are able to meet their income standards. But this will affect the bottom line because, things are more leveraged today than ever within the banking sector. So keep an eye on regional banks, because I don't think the banking crisis is finished, not even close, to be honest. Especially with Janet Yellen telling people, hey, we might have to consider mergers and acquisitions of these banks so they don't actually go into default and create even more bank runs. We might just have to look at their books and start connecting them to avoid that hysteria from happening, because, the house is on fire, and before it catches on to other businesses, we might just have to shut them up by, merging a lot of these businesses. Oh man, Janet Yellen, not looking good for regional banks. That's probably why it's only going to get even more tighter to borrow money. The bank lending standards for credit facilities are going to contract, and that is going to squeeze quite a bit of cash away from the everyday spender, and people are going to have to be more frugal when it comes to how people spend their money. And that's the hope of the Federal Reserve as well, right? To have the banks do a lot more constricting in terms of lending. And if these mergers happen that Janet Yellen's hinting at, well, it might even be a lot more serious than we initially considered. I did call it. I did say that there will be mergers for regional banks because of, the long-durated dated stuff isn't really being taken account by so many managers. A lot of office spaces are putting a lot of pressure as well. And if they default and the lender has to contract even more and that prevent a bank run or a bank walk, they might have to be bailed out by bigger banks, and that might take the 4,500 banks down to, I'm guessing, about 3,000 or 4,000, which isn't very sexy, which will impact us for at least maybe 5 years. So make sure you have cash on hand and take some profits if you've gotten some profits in your investment. So all in all, if you are thinking about real estate, look at their valuations. Be aggressive with your offers so you get a good deal, right? If you are going into it. But please be patient. Real estate is a long-term game. It's not a short-term game. So wait for things to drop if that's the sentiment that you're seeing. If you find something with a great location and it's a mama papa shop that have a good history and, regular cash flow during all of, during the pandemic and during right now, and they can generate income, help them buy them out. That would be a great business opportunity. Not all real estate commercial investments is a bad idea. There are opportunities in there, but please do your due diligence and make sure you're looking at great evaluations. The last thing you want to do is overpay for anything. If you picked up something today that you like, make sure to hit that like button in this video. If you haven't yet, be sure to subscribe for more financial almanac news. I'm Basil. I'll talk to you guys later. Bye-bye.